Hello everyone, and welcome back to the channel. Today, we're diving into a topic that many people find confusing, a little intimidating, but incredibly important: inheritance tax. You might have heard it called the death tax, and it's a subject that's been in the news a lot lately, with talk of some major changes on the horizon. So, what is it? How does it work? And why is everyone suddenly talking about it? Stick around because we're going to break it all down in simple, easy-to-understand terms. First things first, what exactly is inheritance tax, or IHT as it's often abbreviated? In the simplest terms, it's a tax on the estate of someone who has passed away. An estate is just a fancy word for everything a person owns: their property, money, investments, and even their possessions, like art or cars. If the total value of this estate is above a certain threshold, the government takes a percentage of the amount that's over that limit. So, what is that magic number? In the UK, every individual has a tax-free allowance called the nil rate band. But wait, there's more. On top of that, there's another allowance called the residence nil rate band. This is an extra $175,000 that you can use, but only if you pass on your main home to your children or grandchildren. So if you combine these two, a single person can potentially pass on up to £500,000, $325,000 plus $175,000, completely tax-free. And it gets even better for married couples or those in a civil partnership. Spouses can transfer any unused allowance to each other. This means that, in theory, a couple could pass on up to £1 million to their children without paying a penny in inheritance tax. That's a significant amount, and it's why a large majority of estates in the UK, over 95%, don't actually end up paying any inheritance tax at all. So if most people don't pay it, why is it such a big deal? Well, for the estates that do exceed the threshold, the tax rate is a hefty 40%. That's a significant chunk of money. Imagine an estate is worth $1.2 million. The first $1 million is covered by the couple's combined allowances. The remaining $200,000 is then taxed at 40%, which would result in an $80,000 tax bill. You can see how this quickly adds up, especially with rising property prices pushing more estates over the limit. Now let's talk about the buzz in the news. Why is there so much discussion about changing inheritance tax right now? There are a few key reasons. Firstly, there's a political argument that it's a form of double taxation. The logic goes that the money and assets in your estate were already taxed when you earned them, through income tax, for example. So, taxing them again when you pass away feels unfair to some. It's seen as penalizing people for saving and investing throughout their lives. Secondly, there's an economic argument. Some economists believe that abolishing or cutting inheritance tax could stimulate the economy. The idea is that it would encourage older generations to spend more freely or to invest their money, rather than holding on to it purely for tax planning purposes. This trickle-down effect could, in theory, boost economic growth. It also encourages wealth to be passed down and used by younger generations, who might use it to start businesses, buy homes, and fuel the economy. And finally, it's just a very politically popular idea. Let's be honest, nobody likes taxes, and a tax associated with death feels particularly sensitive. Promising to cut or scrap it is often seen as a way to win over voters, as it taps into a desire to protect one's family legacy and pass on hard-earned wealth to the next generation without government interference. So what are the proposed changes we're hearing about? Well, nothing is set in stone, but several options are being floated. The most dramatic would be to abolish the tax completely. Another popular idea is to significantly cut the rate from 40% to something lower, maybe 20% or 30%. A less drastic but still significant change could be to increase the tax-free thresholds. For example, raising the nil rate band from $325,000 to, say, $500,000 or even $1 million per person. This would immediately take millions more families out of the inheritance tax net. Of course, not everyone agrees that cutting IHT is a good idea. The main argument against it is that it would primarily benefit the wealthiest households. Opponents argue that inheritance tax is a vital tool for reducing wealth inequality. It helps to redistribute wealth from the very richest estates to fund public services that benefit everyone, like schools, hospitals, and infrastructure. The numbers back this up to some extent. The revenue from inheritance tax is significant. We're talking about several £billions a year for the UK government. Scrapping it would mean that money has to be found from somewhere else, either by raising other taxes like income tax or VAT, or by cutting public spending. So the debate becomes, is it fairer to tax large inheritances or to raise taxes on the general working population? It's a complex ethical and economic question with no easy answer. Now, while the politicians debate, what can you actually do? There are several established, perfectly legal ways to manage your potential inheritance tax liability. One of the most common is gifting. You can give away up to $3,000 each tax year, and this is immediately exempt from IHT. You can also make small gifts of up to $250 to as many people as you like. For larger gifts, there's something called the 7-year rule. If you give a gift and then live for 7 years after making it, that gift generally falls outside of your estate for tax purposes and becomes tax-free. This is a powerful tool for passing on wealth during your lifetime, but it requires careful forward planning. Another strategy is putting assets into a trust. Trusts can be complex, but they essentially allow you to control how your assets are managed and passed on, and they can be very effective for tax planning. Finally, life insurance can also play a role. You can take out a life insurance policy that is written into a trust, which pays out a lump sum on your death to cover any potential inheritance tax bill. This means your beneficiaries receive their full inheritance, with the tax bill taken care of by the policy. The world of inheritance tax is complicated, and because the rules could be changing, it's more important than ever to stay informed. My goal today was to give you a clear, foundational understanding of how it works and what the current debate is all about. This isn't financial advice, of course, and if you're thinking about your own estate planning, it's absolutely essential to speak with a qualified, independent financial advisor or a solicitor who specializes in this area. They can give you advice tailored specifically to your personal circumstances. So, to recap, inheritance tax is a 40% tax on the value of an estate above a certain threshold, but generous allowances mean most people don't pay it. There's a big political push to cut or scrap it, driven by arguments about fairness and economic stimulation. However, this would come at a cost to the public purse and primarily benefit the wealthiest. While we wait to see what happens, there are legitimate financial planning strategies you can explore right now. I hope you found this breakdown helpful. It's a complex topic, but hopefully it feels a little less intimidating now. What are your thoughts on inheritance tax? Do you think it should be abolished, or is it a fair tax? Let me know in the comments below. I'd love to hear your perspective. Thank you so much for watching. If you enjoyed this video and want more content that makes complex financial topics simple, please give this video a thumbs up, and don't forget to hit that subscribe button and ring the notification bell so you never miss an update. It really helps the channel grow. Thanks again, and I'll see you in the next video.